Good evening, everyone, and welcome to session 2 of IITMAA Investors Series. Today's topic is how wealth actually works. I'm Priyadarshini, Program Manager at IIT Madras Alumni Association. So we are delighted to have with us Mr. Atul Shinghal, founder and CEO of Scripbox, one of India's leading digital wealth management platforms. Under his leadership, Scriptbox has helped thousands of investors make smarter financial decisions through technology driven, goal based investing. With over decades of experience across technology, entrepreneurship, and financial services, Atul has been at the forefront of making wealth creation simple, transparent, and accessible for everyone. His deep understanding of investing and personal finances has made him a trusted voice in the industry. Please join me in extending a warm welcome to both Mr. Atul Singhal and Mr. Sridhar Buvaragwan, President of IITMA. Sridhar sir, over to you. Thank you.
Thank you, Priya, and welcome again to another edition of the Investor Series. So glad that Atul so readily accepted, and I'm also so grateful that a lot of my batchmates have been helping out on all these initiatives that we have been doing, especially photography, quiz club, and the investor series. Atul, of course, is a great resource. We've had some, obviously we knew each other from the first year onwards. We had some big, mischief towards the end of first year, but all that is in the past, and he has gone on to achieve a lot of things, which he will talk about, especially his company, and we're all looking forward to hearing his insights and hearing his experience. Last session by Shankar and Naren was fantastic. If you guys missed it, please, there is a YouTube video of that. Please go through that. And Naren was also equally good in terms of the breadth of topics that he covered. Atul is going to bring a different perspective, different focus, and looking so much forward to hearing Atul. All yours, Atul. Thank you.
Thanks, Sridhar, and to the IITM Alumni Association for organizing this. So first of all, thanks to everyone for dialing in on a Sunday evening or Sunday morning, depending on where you are. And apologies in advance. To fill the shoes of or to follow somebody like a Naren is absolutely disastrous for anybody who's presenting. Naren in India is considered the father figure of investing, and he's also an IIT Madras senior. But he did make my job much easier. I mean, if you did listen to the webinar, he did end by saying that my job is to manage the asset and to find the right fund manager is Atul's job. So with that segue, I'll talk about what I want to achieve today. I'll pre-warn you, it's going to be a extremely boring session because wealth management is like watching paint dry. Can you just mute everybody? So it's like watching paint dry. It's just a process. It requires immense amounts of patience. And I hope I can bring that across to you. So I've got a small presentation. It should take about, I would say, 20-25 minutes, if not faster. And at the end of that, obviously, it'll be interactive as always. If you can see my screen, I'll get started. Yeah, we're good. Sridhar, you can see my screen?
Yes, Atul, we can. Please go ahead.
Okay, so the topic is how wealth works actually. So in terms of the process, I'll sort of be a megalomaniac and start by introducing myself. I'm one of those classically overeducated, underpaid guys as an entrepreneur. Mayo College, went to school. I'm a Fauji kid. In sense, my father was an army general. Was Ganga 91. So the Ganga part is more important than anything else. We were Strata with champions 3 times over. And being lazy and not clever enough to go abroad, being a naval architect anyway, I rolled into IIM Bangalore, finished my sort of MBA there in finance, but picked a job in sales and marketing at a thread company called Coats India. Did 5 years of that. I think all that I learned in a long, long time was there. Selling thread to tailors at 2 rupees a tube across the country really taught you the value of money, that taught you the value of value itself. From there, because the industry was not going very far in textiles, I moved to Standard Chartered, was in the card division, learned a lot about retail lending, then spent 7, 8 years in South Africa with Capital One. And Capital One was in a joint venture with Old Mutual there. In the last 2 years at Old Mutual, I had the privilege to build in 2005, 2006, or 2006, 2007, a digital business, which included a bank, a life insurance company, and a general insurance company. And the reason I'm giving you this relevance is that we understood digital before the internet was a big thing or mobile phones existed. So I've always been a big fan of digital data, and people confuse digital with online. Digital is not online. Digital is technology, data, process, evidence. And that's what we've been trying to bring at Scripbox. I came back to India in 2008 to set up an asset management company. But the business we had built in South Africa didn't go live because of the global financial crisis. So I decided to come back home to set up Old Mutual's asset management company in AMC, which is a mutual fund manufacturing company. But again, unfortunately, Lehman Brothers happened, and I became footloose and fancy free. And I'm an accidental entrepreneur because I had sort of learned about digital over 2 years of building a business. We had 250 people on the ground, and I had seen the AMC industry from the inside. I believe there was an opportunity to do something interesting in the sort of solving a basic problem around wealth. And the theory was that if you want to create long-term wealth, you have to be in equity. If you have to be in equity, it's better to be in equity mutual funds, especially for somebody investing 20,000, 50,000 rupees. So when we started as a pure digital platform, we were only targeting what we called early savers, and it's become relevant to more people now. So the idea was that if you want to create long-term equity, long-term wealth, you have to be in equity. If you have to be in equity, direct equity, if you don't have the time, if you're not a full-time investor, and I'm not talking about speculation, I'm not talking about F&O, but if you're not a full-time investor, spending as much time and as much intelligence as Naren and his entire team of research analysts, it's probably better to trust somebody else with your money. So we said, how do you decide which mutual fund to buy? At that point in time, I remember going live, there were 850 equity schemes. And when you sort of unpeeled the onion, there were only 243 stocks under those 850 schemes. So we realized this is too complex for the regular investor. So how do we pick the right schemes? We believed in portfolio theory, and we still do. So we created baskets for clients to achieve their objectives. I won't bore you with all of that. So today's session talks to you about my learnings and my company's learnings as we've done this. So the interesting one is however long I've been doing this, the one question I get asked most often, and I think we've seen that in our own Mavericks group, the investor group, which fund, which stock, which instrument should I buy? And today that too, right? And this is a continuous question that there's an old Maruti ad which says, "Kitna deti hai?" I think it's a very reasonable question, and I probably started that when I was younger. But I think there are other questions we should answer before we come to that, and I'll cover some of that as I go through. The three questions that I think matter. The first is, what is the money for? Why are you investing this money? What is the purpose? What amount will you need? So are you trying to retire? Are your children going to go to college? Do you want to buy a bigger house? Do you want to save up something? So when do you need the money is as important. So do you need it in 1 year, 3 years? Liquidity is critical. And how is tax going to play out? And your tolerance for a fall. So what is your appetite to handle markets like now, right? They've been down 8-10% for the last 2 years. The more important question, once you've decided where you want to go, is how will you get there? So what's the journey? And I think Naren talked about the asset allocation part, which asset to pick, what is your risk appetite? And equally importantly, in that asset mix, what product to pick? There's a question on that group the other day, should I pick an SIF? But how does it fit into your particular asset mix? And I'll cover some of that. And more importantly, once you've sort of decided where you're going, you've mapped out your journey, will you stay the course? Or will you get freaked out by the markets? And do you have the patience, right? And more importantly, as you stay the course, the road changes. You'll get speed bumps. You'll get, and how do you navigate that change in a systematic manner? But we've now proven this repeatedly. The only mantra for wealth creation in the long term, anywhere in the world, is asset allocation. The first question, and there is no point getting started without it. And I think we asked a question on the financial plan. And the financial plan is not a 1 year, 3 year plan, it's a life plan. In India today, and I talk with the average lifespan is now 71, 72. For people in our social strata, and that 71, 72 average includes infantile death and what have you, it's probably going to be 90, 100, especially with the breakthroughs in medical science. So thinking through your goals and your financial plan to be 30, 40, 50 years is really, really important because inflation will increase, cost of health will increase. So keeping all of that in mind is, and as I said, if you do not know where you're going, no road can take you there, right? You're always basically that speed versus velocity we used to talk about at IIT is the important part. A goal is basically a combination of a number, a date, and a tolerance, right? Something which you need in a year from now, your tolerance for variance is very low. But something you need in 10 years, 20 years, obviously your appetite for variability is higher, right? So anything which a plan which is beyond this, right? What is the amount of money you need? What are your assumptions underlying that? By when do you need it? And these are multiple goals. I'm not talking about one goal. It could be children's education. It could be retirement. It could be a bigger car. It could be the next house. It could be just a quantum of wealth because you want to leave a legacy. It could be a legacy for your grandchildren and your own tolerance for this, right? So what you're saving up for your grandchildren, you probably want to be slightly more risk averse or maybe more even higher risk because that money is 30 years away, right? So it's understanding that is basically what a good financial plan is about. And I hope all of you have one. If not, please get one as soon as possible. And as an example, in this financial plan, right, same market, investing in Indian equity, there are different people, right? People who are still climbing, right, who are in the 30s, 40s, maybe even 50s, who still have to reach their goals. People who are close to retirement, like some of us, right? I'm 57 this year, hopefully retire in 60, 62, 65. And then there are people who are sort of abroad, and somebody messaged me earlier that Atul, I've got interest in multiple countries. So again, for the same market, for different goals and objectives, you'll create a different portfolio. The second question, and probably the most important in my view, is how will you get there? So the road you take is as important as the destination. So it's basically understanding how you're going to get to where you want to go. So again, I'll repeat myself. Start with the goal, and there could be multiple goals. Then choose the right asset allocation, right? How much Indian equity, and as examples, international equity, gold, fixed income. You could have commodities, you could have real estate, you could have different asset classes. And as Naren spoke about, they behave differently at different points in time. And they have a different liquidity profile, they have a different profile, and I'll talk to that. And once you've chosen your asset allocation, you need to choose the products that. And most people choose the other way around, right? They start with buying a mutual fund or a stock or a ULIP or whatever, right? So you're more interested in the product because unfortunately, most of the industry, at least in India, is focused on product sales. They will talk about wealth management, but largely they will be selling you an AIF, they'll be selling you a PMS, they'll be selling you a structured credit product, or even an NFO. But largely it's product sales rather than the left to right picture, which is the right way to do this thing. So I'll talk a little bit about theory, right? There are only three things you can do with your money, right? Broadly, from a investment perspective. You can own a business, means you can own a share of a business, which is what is called equity. You can lend to a business, right? So a corporate bond, you can do peer-to-peer lending, you can give it to a bank, or you can hold it in a bank as sort of cash, as a casa or something, right? And I don't think there is, right? So you can buy property, which is like owning a business. So broadly, think about asset classes, and this is not exhaustive, as risk assets, which obviously have risk associated with them, but basically talk about owning an asset, right? And they will grow in capital appreciation. The non-risk assets are, which are generally income generating. I mean, obviously there is some risk associated, nothing is risk-free, but relatively they're safer assets. And then there are physical assets or personal assets like real estate, physical holdings. In international equity, you can have US equity, you can have global funds, you can have emerging market funds, you can have derivatives. I mean, there are many views. So all I wanted to lay out was basically If I go back to this, and why am I a big fan of equity, right? So think about this. If you lend to a bank, the bank is probably going to give you a 6-7% interest because that's what they feel is fair. What will the bank do? In turn, they will lend it to a good business who they believe will give them 11% back. So they make a 3-4% spread on that one, right? So now they're giving it to somebody who's going to give them back 11%. What will the person who's a good borrower do? Will earn 15%, so they can give back 11% and they can keep 4% as profit. So why don't we go and participate as long as we have the risk appetite and we have the processes right up the value chain, right? So if you go find the source of the money rather than the downstream and you play upstream, it's always better to own a business, right? And that's why the big love for equity in the long term. Because if you and especially in a country like India with sort of inflation at about say between 5 to 7% and real growth in again 5-7%, a good business should be able to grow between 12-14%, and a 12-14% compounded over time is a great business to be participating in. Now, I'll just take an example, and I think the engineers will enjoy this. So obviously, there's a risk return graph for everything. The lower the risk, the lower the return. Pure money market overnight fund which you deploy will probably earn 3-4%. This is just indexed. I mean, don't bother about it. Something that on the right side, like private equity and venture capital, has a far higher risk and possibly a far higher return. But it's also important to remember that the standard deviation of that return graph is equally broad, right? So when you go to money market, I think the risk curve, the risk spread is literally zero. You get to bonds, you could find a DHFL or something, they're slightly higher. Large cap equity, you could have cyclicals, you could have the AI trade. But again, the risk spread is relatively lower. It's when you get to the right extreme, whereas private equity and venture capital, where sort of risk becomes far greater in terms of the spread. Again, the return is also equally higher. So understanding that this risk return profile for every asset class actually varies over time. And I mean, it's a carpet which shows you just 3-4 things: Indian equity, US equity, gold, and debt returns in INR over the last till calendar year 2026, over the last sort of 22 years. And as you can see, there is no single winner ever, right? Gold gave 72% in calendar year 22, in calendar year 25, but was flat for many years before that. Right. So just understanding what the risk return profile is, and that there is no singular winner at any point in time. And it's I would trust the experts like Naren and Vasan and the others in the industry or globally, the fund managers, to be understanding these cycles and to understand what to do in a more regular manner than a retail investor like we have on the call. Now, even in an asset class like Indian equity, right, and you just take the spread across large cap, mid cap, small cap, again, there's a huge dispersion, right? And the money has to be made largely. The alpha is to be created by picking the right asset class at the right time, and within that, the sub asset class, right? And that's the critical part about when I talk about the asset allocation piece, that one, you've decided your goal, and within that goal, how do you pick the right, keep yourself abreast of what to do is really important. Now, obviously, I mean, the theory is that if you use different mixes, if you take, say, equity debt, 70 equity, 30% debt in India, the last 1 year return has been minus 4.3. The 3 year return has been 7.3, but a 10-year return has been 10%, right? But the minimum, the most drawdown has been 33%, and the highest has been a 58% return. Right. So it's this, what do you want to do? And pure Indian equity, if you look at the last 1 year, it was 7% negative. So equity debt portfolio was slightly less risky, right? Whereas a 50 equity, 25 debt, and 25 gold gave you 8.6% return. So actually, it's this asset mix aligned to your goal, which will help you get to
cook some.
Now, what asset allocation does makes a bumpy ride smoother that the drawdown reduces as you go further to the right, right? So a pure equity portfolio can have a 47% max drawdown in the period of analysis with a 10.6% upside. And it's blending these, say, in the middle, 50 equity, 50 debt, gives you nearly a similar return at 9.9, but gives you only a 24% chance of a drawdown. So again, your risk tolerance, your return aspirations is what determines what your asset allocation is. I'll not go. So this is basically saying that if you bought only in Indian equity, you'd experience the drawdowns and the heart attacks around the red curve. If you blended it with say debt and gold, you'd experience the green drawdowns. Again, the two pieces I want to highlight is you've decided your asset allocation, you've got somebody guiding you, you've decided how to be managing this asset allocation in a regular manner, watching your asset allocation, seeing what to pick, when to pick, what is the mix of that. Then you have to pick the fund, right? Now, if you've taken large cap and you decide, hey, I want to be only in large cap and not in mid and small cap, or within large cap, I've decided I want to buy, say, ICICI Pru because it's ranked number one. But it's very likely that it might not be ranked number one next year or in the next 3 to 4 years. So a top rank is not a strategy. Understanding the process, understanding the fund manager's track record, understanding the process they follow, understanding sort of the underlying securities they have is equally important. As an example, if I take flexi cap funds, and I'll only give one example, there are 40 funds with over 1 year history in India. The best person returned 12.4. The median was 3.1, and the worst was 7.2. So it's a 20% dispersion between the top and the last, right? So how do you decide which one to pick, right? And that's a science, and you need math, and you need process around picking the right scheme or the right manager or the right product or the right fund in the asset class you choose. The last one, which is the third question, which is where a lot of people lose their way. Will you stay the course? I mean, this graph you would have seen every day, everywhere. While it's secularly upwards, in the moment, it looks very, very chaotic, right? There are so many things that happen. There was Ukraine, there's Iran, there is Trump, there is the global financial crisis has happened, the internet bubble has happened, the AI trade is happening, the yen crisis happened. So all of these are different points in time. And like today, the biggest question we keep getting asked is that, boss, the market is down 10, 12% for the last 2 years. What should I do? I mean, is it a good time to exit? Should we be buying something else? And the repeated answer is the compounding will take care of it. Just have the patience, and depending again on your time outlook. This is the odds of a negative return for a given time period, right? So if you look at the last, say, 20-year history, or this is 34 years actually, if you look at the worst drawdown on a single day is 46.7%, right? Or the number of times we had negative returns in the daily volatility. So 50% time the market will go up, 50% time the market will go down. Whereas if you take a 10-year view, only 0.4% in that huge rolling 10-year return has there been a flat market, right? Even then, you do not lose money. So it's this basically period that you have to understand that the chances of you making money and not timing the market, but just staying time in the market is the really important part. While you do that, and then I talked about the asset classes moving, there's regression to the mean. What rebalancing is equally important. So, for example, you had a 70, 20, 10 portfolio. 70 is not performed. 70 is now become 63. Your 20 has now become 24. The 10 has become 13. Now, it is important that at least on an annual basis, depending on your goals, depending on the outlook of the market, you rebalance your portfolio, right? It's again a science behind it. So you have to optimize for liquidity, you have to optimize for tax, but doing all this in a really important manner is what wealth management is all about. In summary, what I wanted to say was that what wealth management does is It understands the person, understands their goals, understands their aspirations, understands their risk. Then, based on that, creates an asset allocation. In that asset allocation, it populates products. And then, obviously, over the course of the journey, which could be 10 years, 20 years, 40 years, it rebalances, it helps that client rebalance because goals also change, right? And aspirations change. So, how do you do that in a systematic manner is what a wealth manager is supposed to do. I'll do a solid example of somebody managing a retirement corpus. We believe the money you need now, say in 3 to 5 years, or zero, say now to 3 years or 5 years, you can put into low risk, high liquidity funds like arbitrage funds, which are tax efficient. You could do fixed deposits if you are in the right age group. You could do liquid funds. What you need, say, 3 to 8 years from now, you could take a little bit more risk. You could do an equity savings fund, which get taxed at equity rates. You could do balance advantage funds. You could do other hybrids. What is later, say 7 years and beyond? Definitely, given the Indian markets and given global experience, buying equity funds would be the right answer. Or equity and equity linked products would be the right answer. And what you typically do is that you keep rebalancing the bucket. You start with something, 3 years later, I mean, a year later, you keep moving. So you keep creating liquidity in a tax efficient manner as you keep going forward. So this is just a solid example. There'll be similar examples for everybody, and each individual is different, right? Each person's circumstances are very different. Their children are different. Their aspirations are different. Their locations are different. What wealth means to them is different. What enough means to them is different. So getting that sorted out is really critical. So in summary, I'll stop now this lesson. Turn your money into wealth. First and foremost, have a clear plan that you review once a year. You design an asset allocation to deliver on that plan, put in the right products inside that, and then stay the course with suitable connections. I'm sure you can do all of this yourself. It is just that what is more important to you, your time? Would you be rather, as Naren was saying, you're a great chip designer. Would you be designing more chips? Would you like to spend time with your children? Would you like to read a book? Would you like to go on holiday? Or if this interests you, you can do this on your own, is essentially is what I'm submitting. I'll come back to the slide in a minute. What we have found, at least in people we speak to, there is a huge knowing-doing gap. The presentation I've done, you would have read it. I can go blue in the face. Anybody who's worth their salt in wealth management will tell you the same thing. This is not rocket science. It's just that we found that this gap between knowledge and action is reasonably large because people are busy, people have other interests. Speculation is what happens. So what you need really, and I apologize in advance to Sridhar and the team, I will do a sales pitch. You need a well-wisher in this journey. Somebody who's both, what I would say, an experienced co-driver and a seat belt. And what do I mean by an experienced co-driver? Somebody who's been down this journey, who's seen the ups and downs, and more importantly, prevents you from making mistakes, right? The seatbelt's job is to make sure that you don't panic, make sure that you don't get greedy, you don't buy at the wrong time, you don't sell at the wrong time. It's just hand-holding through the entire journey for the next 30, 40, 50 years. A little bit about Scripbox, and I'll come back to that earlier slide. We have been around for 20 plus years. I've been running this company. We acquired lots of experience. We have about 8 offices across the country. We're amongst the largest. We're the largest independent mutual fund distributor in the country. We have a footprint in over 600 cities in terms of our clients. We have branches in 8. We've served over a lakh families. The vision of the company is to serve 1 million families. Our team size is over 230. For our size, it's actually quite efficient. We won our fair share of awards through the years. So God's been very kind to us. And if any interest is there, you really think that what I've said resonates with you, and I'm going to answer questions, you can scan this and fill a form. Somebody from my team will get in touch with you. So I will stop the presentation. I wanted to spend a minute on this question. Sorry, we're going the wrong way. In terms of which one are you doing? Now, think about your own thinking. What I talked about is called investing. And you can do it on your own, which you pick, you understand the market, you understand your needs, you pick the right mutual fund, you pick the right stock, you could pick another asset class. Speculating uh, is something you're buying to sell quickly, right? It could be daily, it could be part of your portfolio, right? Samik Sridharan, who's on the call, is an absolutely fantastic guy at understanding market movements, understanding currencies. What I avoid and I tell people not to do is gambling, which is FNO, right? In gambling, as you would know, if you go to a casino, the house always wins. So any trade where there's one loser and one winner, you're hoping you're the winner, but there's an equal chance you'll be the loser, right? So my humble submission is stick to the as far as possible to the right. So you can scan this last final parting thought, which I live by. Good judgment is the result of experience, and experience is the result of bad judgment. So we'll all make our mistakes. We made our fair share. But that said, thank you very much for your patience. And now I'm open to any questions. I'll stop sharing. Over to you, Sridhar. I'll put that, we'll share the QR code if you want. I hope there was some logic, some sense in what I said. Would love to hear questions from here.
Thank you so much, Atul. Why don't I start with a question? Now that, see, the kind of questions that you posed to an investor, what are you doing this for? What is your time horizon? And those are all good questions. Now, let me ask you from practical experience, how many people actually think of all that instead of chasing after what has been doing the best in the last year or so? So, how much of chasing returns do you see rather than a systematic? See, I know what you want people to do, but I know also that there are impulses among people. So, how do you see that, and how do you try to guide them to avoid it?
So I'll give you a live example of my own elder brother, right? He's a serving lieutenant general in the army, right? And he has the same, I mean, because their risk appetite is so much larger than any of us, right? So what I've done with him is I've taken 90% of his money and we manage it under a goal-based plan. 10% I let him do what he feels like. So because that urge is there, and I'm not telling you don't live that urge, right? Yes, it is there, and you want to be doing things, and you want to be reading, and you want to be speculating, and you want to be sort of investing. So you should. I mean, the way the answer is, see, it's a need everybody has. It takes a hugely evolved person like Warren Buffett to watch the paint dry. All I'm saying is that having a plan really helps. It's difficult, and I mean, a lot of us don't because you're so busy, and we don't spend the diligence of making that plan, which is long term. And I mean, some of us have already made the money. We're retired. We say, okay, things are taken care of and I can take a lot more risk. But if you think about life 30, 40, 50 years more from wherever we are, you have to have a plan. And more importantly, one thing to remember is that the breakthroughs in medical science or health are double-edged sword. One, they give you longevity. Secondly, they could come at a price you can't afford, right? So having that nest egg for God knows when is equally important. The long answer to your question is it is normal human behavior. My job is to keep repeating. If you don't have a financial plan, I'm a bad guy. So it's a boring thing. It's hard work, but people who stayed the course. I mean, I'll tell you, our first cohort is 2013 when we started Scripbox. We're 20 years old in the sense we bought some businesses. The cohort's value was about 2 crores of all the clients put together. And some clients stayed the course, some put in more money and whatever. The value today of that cohort is 140 crores. Right? That's the power of compounding. That's the power of staying the course. That's the power of investing regularly.
Guys, if any of others have questions, please feel free to unmute.
I have
and
a question. Am I audible? Can you hear me?
Yes, I can hear you.
Yeah.
Please introduce
So,
yourself.
Atul, thank you very much for this presentation. I actually love stock market, and I'll be retiring soon, and planning to take a direct equity investment as my profession. I mean, it's a full-time kind of thing. So, what would be your suggestion how to go ahead with that? I have read quite a few books and practicing for quite some time. I mean, looking into charts and then figuring out when it is breaking out and all those things. Um, I mean,
So
for
I'll
little amount of money, I understand I am comfortable, but when it's a question of investing few crores of rupees directly into equity and everything managed by me, kind of bit nervous, feeling nervous how to do that.
You answered your own question. Yeah, I mean, the answer would be that learn it slowly. Yeah? I mean, you've got a long life ahead of you. Why do you want to put all your money, right? If you have say X crores or say let's say 100 and as a number, index number, start with 10. Put 90 into something that let that 10 double to 20. Then take another 10 out. Why risk your capital to prove what? Right? You've got 30, 40 years ahead of yourself to do this, right? Part of it is the wealth creation, part of it is the thrill, right? So you can't use your entire corpus to pay school fees, right? The example I give is that we keep getting asked this angel investing and startup investing. I say if you don't have a 50 crore net worth, don't touch it with a barge pole, right? And people say why, and the answer is that if you have to see any sort of if you're earning if you want to really make money, you want to enter early for extraordinary returns, right? For angel investing as it is, and that typically liquidity is 10 to 12 years. The mortality rate in startups, funded startup, is between 70-80%. So typically you'll either pick a fund manager or you'll pick a company you want to invest in. If you want to invest, if it's 80% mortality rate, you're not some James Bond, right? You'll have a say 70% mortality rate. That means you have to, and then you have to back the company second time, third time to hold your corpus. So anything less than 5 crores committed to an asset class in this kind of asset class, which is 10 to 12 years liquidity, low, is difficult, right? If you take, say, 10 bets of 50 lakhs each, and then or 10 bets of 20 lakhs each, and then you double down on a couple. So, and more than 10% of your asset base in a single asset class is again dangerous in a high risk asset class. So that's why the 50 crore number. Similarly, for you, the answer is that if it's a new field to you, I know however clever you are, however intelligent you are, take your time over it, right? Don't rush it. Let 70% of your net worth be in relatively well managed assets from experts. And then as you get better, as you learn more, do more. I
Okay,
hope I've answered your question.
understand.
Yeah.
Yeah, thank you.
Any
Any
analytical tool that we could use to guide us in making decisions in investing from Vijay?
My answer would be Scripbox, but you could, I mean, there are lots of platforms which will give you answers. I mean, so since I don't understand direct equity, we have a PMS which is completely math based. We don't pick individual equity, but I think there is. I mean, something like I'm sure Samyukt will cover this in the next session or whenever he does his session. There are things around fundamental analysis. There are technical analysis. There are momentum stocks you can buy. So it depends on what you're comfortable with, right? I would not be in a position to give you a specific name. All I can tell you is that if you follow this simple mantra, have a goal, put an asset allocation and production against that goal, and keep watching it or keep monitoring it and course correcting, you'll win. And I mean, Scriptbox is not the only app. There's Betterment and Wealthfront in the US. There's Personal Capital in the US. There's Nutmeg in UK. There is Grow here. There is Covera. There are enough good people doing good work.
May
Yeah, please.
the question you are rightly brought out the having a plan and then having an asset allotment as per the plan, correct? So the majority of us will be planning for going for a mutual fund allotment.
Yes.
But is there a way that we can evaluate a mutual fund? You have clearly told the old results or the old returns are not the benchmark for the upcoming returns. So see the and the bell curve also you have shown that same for the same fund we might get a return of 2% and the fund house. If we change the scheme, then we might get a 15% return also in the same broader large cap
Asset
or
class. Asset
yeah,
class. Asset class.
yeah.
Yeah. Sub asset class. Yeah.
So is there a way that we can evaluate the fund or a simple thing where we can evaluate a fund and then so that we can have a fixed this thing, at least we can expect this much from this fund?
And I think you asked two very different questions, Prabhu. One is there a tool? I mean, that's what we do for a living at Scriptbox. We've built our models, we've back tested them. I don't know what an equivalent out there is in terms of assessing mutual funds within a category. I'm sure there are tools available. It's just not that I've come across something so scientifically available. They'll all look at past returns, they all look at different things. But I think it's worth my view, and this is not to sound salesy for myself, but find an advisor. Yeah, it's worth paying the 60, 70 bips you pay extra to just have somebody to do your work for you. You go to an eye doctor when your eyes are bad. You go to a doctor when when you need the help, right? So it's best to talk to an expert. I'm sure you're an expert in something and you expect people to come to you for that. Similarly, there are financial advisors, there are big companies like 361. So there's things you can do to find that. So a specific tool which will help you analyze specific mutual funds, because style matters, the fund manager's process matters. So it is an evolved process to figure out which mutual fund is likely to do better in the coming foreseeable 18. Because see, all data gives you history. It's retrospective. What you're trying to do is prospective, right? Looking ahead. So how do you do that balance is the difficult part. And I wouldn't have a straight answer ki this is the only method you could do it. The second thing you said, can it that assure you a fixed return? Nobody, and I repeat, nobody in the world can assure you a fixed return apart from say government bonds, and even there we've seen defaults. But yeah, I mean there are lower risk products in fixed income. But if you're picking in the equity space, you have to live with the vagaries of the industry.
Yeah, actually, one point I used to keep saying my friends also, selecting an advisor is like selecting a doctor. You will not come to know the results immediately. You will come to know the results after 5 to 10 years, so which is too late also. So we'll take.
Yeah, so you have to find somebody you feel comfortable with culturally, somebody with a track record, somebody with. So why do I say we are building a 100-year institution? It is not to be megalomaniac. It is basically wealth is multi-generational, right? You want the institution to outlive you and the advisor. So basically finding somebody who's going to be around next 30, 40 years, if your wealth is going to be around, is the answer.
Yeah, thanks.
How to handle
Priya,
emotions?
I have a follow-up question. So,
Yes.
Atul, I've been both from Naren's topic last 2 weeks ago, and now there is a lot of, I mean, and your graph of the number one mutual fund company in one particular year becomes 25 the next year was really surprising. I don't have too much experience with Indian investment products and fund companies and so on. But can you draw possibly or a contrast between, let's say, the US landscape of a similar, investment products there versus in India? For example, in the US, there is a lot of index funds and index fund managers that are quite active, and they probably are managing a huge amount of funds there. How is it in India? I'm not that familiar with that space. If you
So
could shed
I
some
think
light
Naren
on it.
answered that, right? Passives are yet to take off in India because alpha is still available, right? So there is alpha
Okay.
available both in the asset mix and the fund selection and the stock selection. So I think that allows you to continue to find the right person who can help you navigate this. You can do it on your own. I don't have an understanding of the US market, and I will not even pretend that I do.
Okay. Okay. Thank you.
Atul, can I ask a question? My name is Ravi Venkatraman. Can you hear me?
Yes, I can hear you.
I'm from 1971 batch of IIT Madras.
Yes, sir.
I retired in 1980.
Yes, sir.
When I retired, the rate of interest on FD was around 10.5%. So I put the money for 10 years.
Hmm.
And at that time, my monthly expense was 50,000 rupees.
Hmm.
Today, the rate of interest on FD is probably around 7%.
Hmm.
And my monthly expense has gone up by almost 4 times. It's now about 2 lakh rupees.
Yes, sir.
Now, you assume that I have a corpus of 1.5 crores.
Yes, sir.
Can you suggest any mutual fund scheme which can give me ideally around 1% rate of interest per month? Because that's the only way in which case I can beat now the inflation. I can't go back to FD now because I don't have that kind of corpus.
Yeah, so I think the FD is anyway, my view, tax inefficient, illiquid, and
Right.
comparatively.
Right.
So it'll be very difficult to answer that, Mr. Venkataman, Mr. Venkataman Ravi.
Ravi.
That I would recommend, if you don't mind, just fill the form. I'm going to put that up again. One of my people will understand your circum. Where are you based?
I'm based in Chennai.
So I've got a very strong team in Chennai. They will, if you don't mind, they will reach out to you and
For sure.
just fill up the form and somebody will reach out to you. I've got a very great gentleman called A.K. Narayan, who's sort of the right age group, who will be able to talk to you and talk you through the needs. Sir. Sorry
Uh,
for not answering the question directly.
No, Atul, I had the same question. Shankar Rana is a good friend of mine. I used to be active in IIT Alumni Association.
Hmm.
Asked him the same question, and he smiled, and he said that, if I invest on ICICI Balance Advantage Fund, well, I
Hmm.
can certainly I will get about 9% a year. He said, I can't now give a guarantee for about 12, but you'll certainly get
Yeah.
about
So I
9.
think.
I find last 15 years it has been giving more than 15, in fact, more than 12%. Anyway, that doesn't mean that you get the same return in the future, which I
Exactly. So
understand.
we'll do a blended portfolio, like I said. No, so it's a three bucket strategy. It's
Ah,
highly efficient to remove some money. So if you, as an example, you put 50 lakhs into a liquid fund, right, or a liquid
yeah,
close to liquid, even if it gives you 5-6%, but your withdrawing is tax efficient. So you'll get FD like returns, but highly tax efficient because when you withdraw, say that 2
right,
lakhs a month for the next 30 months because of the
right.
increase,
Yes,
your tax is very minimal because on the you're withdrawing principal plus interest, principal plus growth, and
I
you're paying
agree.
tax only on the growth part. Whereas in
True.
the other side, you're paying tax on the entire amount. So I think it's far more efficient to do this in a mutual fund. And you take three buckets. The next 5 years we'll put into a sort of near cash equivalent. The next 5 years we'll put into slightly more risky. And hopefully you live the next 30, 40 years, and the last one runs all the way.
See, I'll give an example. This PPFAS flexible fund.
Yeah,
In fact, I used to know that guy very well in Mumbai a long time back. So I have been investing in that fund every month about 10,000 rupees.
he's good,
Right?
sir.
Every month. So right now it's worth about 60 lakh rupees. I
Leave
haven't
it
paid
there.
even a single penny now as income tax, right? Because it's all getting deferred. Only when I withdraw, in fact, I may have to.
Let's get into specific fund conversations separately, sir. Otherwise, there
Yeah,
are people who
Okay,
are
yeah, if
not.
you do not mind, may I
yeah, I
suggest
understand. Uh,
based on my understanding, equity savings fund, if you choose out of few, you can get more than 10%. And it will
Uh,
be taxed with the as a equity. I mean, if you are holding it for more than 1 year, you have to pay only 12.5% tax.
Depending on how quickly you withdraw it, and equity savings are
Yeah.
not. I mean, my team can answer that. I think Satyam, it's 9% or 8.5. It'll be difficult to pick a specific fund at a category level, but yeah, there's a fair that equity savings is more tax efficient. Again, depending on when you want to withdraw it, sir. Can we just? There are some questions in the chat. Priya, can you read them out?
Questions: how to handle emotions when investing in equity for a long term? How many stocks should one invest in? Often, mutual fund ends up being a black box as we don't usually know how the fund manager rebalances the stocks in the fund. Should we invest based on fund returns or fund manager performance? From
Yeah, lovely. So the first one, yeah, how to handle emotions while investing, depending on how, like, staying the journey. Why did you buy that stock? If you're buying individual stock, because markets will be volatile, markets will go up and down, industries, asset classes. So again, the reason we are pushing on mutual funds is because there is an expert doing it full time. Now, in terms of transparency of mutual funds, they do present a fact sheet every month. You can actually talk to fund managers. I mean, there is a science behind selecting the right fund manager and the right fund. It's a combination of the fund manager's history, track record, their process, their returns, their risk appetite. There is science and algorithm behind that, which if you just spend the time, you'll understand better. It's not a black box in the sense, but obviously the point is that it's like a doctor we were saying, right? If you really don't know if you're getting a stent put in, what exactly the doctor is doing. He's the expert. He's gonna go put the stent in. He'll explain to you what he's doing, but it's his expertise.
I have seen advice where they recommend to restrict investment to just three ETFs or mutual funds, and then pick them based on your risk tolerance. What do you think about this, from Umesh?
Uh, I don't know. I mean, where you've seen this advice, but I'm sure they have justification. So it's not in my place to counter somebody else's advice. We think a slightly broader brush would help, and especially dynamically managing it. As I said, asset classes change, sub asset classes change. I won't counter somebody else's opinion to you. And again, apart from risk tolerance, it's also liquidity, it's also tax, it's also the time frame you're looking to invest in. The answer lies in your specific circumstances. If somebody is giving you this advice, sir.
What is your
There's a question.
expert opinion on taking a loan?
Yeah, please read out. Investing on a
What is
carry.
your sorry?
Hmm.
What is your expert opinion on taking a loan and investing on a land in appreciating place, expecting a minimum of 50% in 10 years versus investing the EMI I would pay into index fund for the next 10 years?
Now that's the $1 million question. So I have no idea. How do you know there's going to be a 50% return on property? And I think Naren touched upon it. Different markets behave differently. I'm not a big fan personally of land as a investing asset, and it's my limitation. The reason I say that is because one, it's an illiquid asset. If you need the money earlier, you can't get access to it. And it's when you are selling, it's always a buyer's market, not a seller's market first. Secondly, the cost of buying and holding and the cost of selling are never incorporated in this 50% return. They tend to be over in that, the stamp duty. Thirdly, in India, unfortunately, land especially is not a transparent asset. We all understand there are other factors where cash plays a role. So I think from that perspective, I would rather do a REITs or a InvITs, right? If you think real estate is a good asset class to go after, then you invest in that. Now, confusing your EMI, which is hopeful, you're borrowing versus you're investing. So again, do you want to be the master of your destiny, or do you want somebody else to be the master of your destiny? It's just that coming to that, right? I would personally say this would not be a great strategy, but this is my biased opinion.
Atul, can I ask one more question, please? Ravi here.
Yes, sir.
What do you think about investing on pure equity on systematic investment? For example, any large, the so-called blue chip, I mean, last 5 years, they're not doing well. Something like an HDFC Bank or ICICI Bank, or maybe a Titan, or maybe an L&T, and do a systematic investment rather than investing only on mutual funds.
Again, if you are absolutely sure, again, like Naren said, markets change, factors change, sectors change. Imagine you had invested in HDFC Bank 5 years late ago, and you were
I know.
expecting a 12% return, and you needed the money today, right? You had a daughter's wedding, or you had your son's something. What would you do? You would have expected that 1 crore has become 2 crores, and you're sitting on 1 crore, and you're now worried. So I think backing a single horse, when you have the option to back all the horses, at least the winning horses, would be a bit riskier than is appropriate. Yeah, mutual funds in India are highly regulated, run by experts, tax efficient, liquid events. I I mean, I just find it why it's simple. Yeah, do the simple thing simply. Is there a proven model or formula to calculate how much money economists we need for retirement, considering inflation and rising living costs and unpredictable market returns? Which again depends on the time frame you're looking at. Some people use the rule of 25. Whatever your expenses today are, inflate them by 6%, 7%, because that's lifestyle cost, health cost. See, some of it comes down because children leave home, or you have less dependents. As you get older, your house is already built. So, but broadly, I mean, depends on what market returns are. So the logic being, and depend again, what time frame are you looking for retirement? If you retire, some of the youngsters here want to retire at 40, some of us want to continue working till 70, right? And what do you want to want? Do you want the corpus to be at the end of that period, whether it's 90, 95, 100? If you want to draw down to zero, right, and you want to be cash rich and asset rich, it's a very different answer. If you think you want to leave a legacy of the entire amount and you want to live a risk-free life, it's a different answer. So there is no formula which I can tell you. Again, you have to make an individual plan, which you have to think about. And also think about that these plans need to include one-time expenses a lot of people forget. So Ravi spoke about that 1.5, 2 lakhs a month, which is his current expense. What you don't account for is upgrading your car every 10 years. Maybe doing some development work in your house every 10 years, maybe having a large life event every 10 years. And they're not all congruent, right? They might be in different years. So these are large corpuses which you might need, right? Which we don't budget for. We only think about our operating expenses or our living expenses. So I think thinking about a plan which has all these, including some emergency money for a real health scare, right? Because is equally important as you make these plans. So Vijay, I don't have a straight answer. The answer is unfortunately as complex, as simple as the question.
Thank you. Thank you.
Hi, Atul. Can you hear me, please? I have a question.
Yes, sir. How are we doing for time? I mean, I can carry on speaking.
Just quickly.
No, I'm good to do.
Anil, and I'm 95 batch of IIT Madras. I live in US. I have two specific questions for you, please. What is your personal opinion on target retirement funds, or also known as freedom funds, where they have a target retirement and they have a blend of a lot of things like conservative to aggressive. You don't have the headache of managing.
Yeah.
So as you are nearing retirement, yeah, they do that. So what is your opinion on that? And second one is, do you provide services for US residents also, your company?
Absolutely. The answer to the second question is yes. There's a dear friend of mine, Balaji, here from Godab 91. He asked me, and I said, yes, we do. Just fill in the form and somebody will get in touch. We have a PMS business, which is tax efficient and more appropriate for you as compared to sort of the mutual funds in India. It's the right product, and we'll figure out how to make it work. So there is a target maturity fund and there's a target retirement fund. India still doesn't have a target retirement fund as such, from what I can understand. But if somebody is replicating the role of your wealth manager, which is what we would do. So what is a wealth manager doing? They're actually creating your retirement plan. All they're doing is they're doing it more sort of dynamically and more in line with what you're doing. So the delta between somebody like us, it'll be personalized for you, whereas a target maturity fund or a target retirement fund is a common corpus for everybody. So it's basically the same. It's a one size fits all plan versus a specific plan. That's the only delta.
Sure. Okay. Thank you. And great presentation, great information. And whom do I contact for the investment thing?
Okay, I'll put up that. What we'll do is on the WhatsApp group, we'll share the QR code. Just fill up the QR code if you don't mind, and one of my team members will reach out to you, sir. If you.
Okay, sure. Thank you. Yeah.
It's up again. So if you just scan this QR code and fill up the form, then somebody will get in touch at your convenience. Absolutely.
Yeah, sure.
Believe me, we don't make outbound calls as a policy. So you can be rest assured you will not be hounded.
And for people residing in US, we don't have to convert everything into rupees and then back into dollars, right?
There's a process. We'll tell you how to do it. It'll be fully repatriable.
Okay, sure.
Yeah, go for it, Balaji, and I'll answer the index question next.
Hey, Atul. First of all, I loved it. One comment and one question. I think the comment is, I loved your analogy about the seat belt, because I've had like a Vanguard advisor for the past 10, 20 years. And I look back and I think over the 20 years, we spend more time talking about pickleball and all that and the crazy things. And the value that they provide is talking me off the ledge, right? Saying, I want to do this. He'll say, hey, don't do that. But despite that, you go off, do some stuff, and then you come back after a few years and say, hey, you told me not to do this. I went ahead and did it anyway. You're like, that's fine. So I think you appreciate the value more if you start looking back at a 5-10 year period. My question was more, if you look at India versus the US, I guess my understanding is in India, 15-20% of the average Indian wealth is invested in equity. I'm assuming that in the US or other locations, it's much more, right? A much larger percentage of your corpus is invested in the market. How do you see that playing out in the next 5-10 years? Any structural changes in the Indian market looking back last 10-20 years versus next 10-20 years?
So I would say 5 years. Actually, the inflection point in India happened with COVID, right? So what has happened is that I think something like 200 million or 20 crore demat accounts have been opened. So I talked about speculating, gambling, investing. So everybody still thinks, or large population still thinks about equity as investing and gambling, or speculating and gambling. I'm hopeful, and we have started to see the early trends of that. You've burnt your fingers, you've done the speculation, you now want to invest for the long term, you want to create wealth. So the move towards equity has started, and clearly the mutual fund industry used to be 10% of the fixed deposit industry. It's now 35-40%. We expect that to keep increasing, right? So the next 10 years, I mean, I'm a complete India fan. The next 10 to 20 years belong to Indian equity. I mean, there are great entrepreneurs building great businesses who are coming into the markets, and I think they will create the future. We might not be only AI, but India is a consumption economy, right? We have 1.4 billion people who are consuming stuff every day, and I think that will continue to support the Indian equity story for some years to come. And I think increasingly people are participating in it. So those 20 million or no, 200 million demat accounts or the 20 crore demat accounts at some point in time have to start translating into people investing for the long term rather than only speculating.
Thanks, Atul.
Well, Atul, one last question. Your views on PMS vis-a-vis mutual funds?
Depends again. PMS is one more product in the asset class. Is it an equity? Is it an equity PMS? Is it a debt PMS? Is it a high risk PMS? Depends again where it fits into your asset allocation. Because the minimum ticket size is 50 lakhs, and again, you should not expose yourself to one particular strategy beyond a particular amount. It'll depend. I mean, there is no versus. It is and. Depends on again how it fits into your portfolio construct.
Thanks.
Last
Atul,
question,
we can
Sridhar,
take,
please,
we will
there's
take
a
one
WhatsApp
more
group.
question.
Is index investing better for retailers? Over long term, even in India, 70% large cap mutual funds underperform index. So my odds of choosing a right fund for my long term portfolio is only 30%. Why choose yourself, sir? There are people who are doing this for a living. Work with them, then you are more likely to be in the top quartile. And how to identify whether my fund is performing well or not? Just look at the median return of that particular category. Look at, again, how is it doing for the last 1 year, 3 year, 5 year rolling return? Do some analysis. If you think that there is legs in the fund, stay with it. And if you think there are no legs, do a switch, like Naren said, don't do a sell. And the fund you need to pick, again, you need to do the same level of analysis because how do you know the next fund is going to perform? So if you have a methodology of picking, then please go ahead. You'll have to do that return, 3-year rolling return, number of outperformances, fund manager performance, the fund manager's track record. So there are multiple factors which go into identifying which fund is doing well or will do well looking ahead. I'll stop at that, Sridhar, because it is Sunday evening for a lot of people, and their families will be cursing me. I'm keeping them from their dinner or drink or whatever they prefer. But happy, please reach out on WhatsApp. I'll try to respond if I can. Again, I will not comment on individual funds. I'm not an expert. I will not comment on individual stocks. I just don't have any clue. But yeah, happy to chat. And thanks once again. I mean, it's a pleasure to talk to IIT Madras alumni. And I hope it was of some value about thinking about your money.
Thank you so much, Atul. Yes, on these kind of topics, I think questions will keep coming. What is the best fund? What is the best asset class? These kind of things, discussions will keep going. I really wanted to thank Atul for explaining to us the landscape of investments in India, what are the choices available, and showing how Scripbox can play an important part in the wealth management that can help you get to your goals. A really eye-opening session. I see what I keep saying when I go to these chapter meets is that we have 67,000 alumni all over the world, and there are people in a variety of industries, and we are blessed to have people like Naren, like Atul, who are in the industries that, let's say, it's not our core area, but it is their core area. And given that we have a connection of an IIT Madras alumni, it is definitely something that we can start a conversation at least, right? And so please take advantage of the services that Scripbox offers and see if it works for you. With that, thank you all for coming. Finance is always a hot topic for alumni, and this webinar was no different. So thank you all for coming.
Thank you, everyone. Have a lovely evening, and cheers, everyone. Take care. Thanks, Sridhar. Thanks, Priya. And again, we should thank the IITMAA, the webinar team. I mean, Priya and all put in a lot of hard work into this. So thanks, Priya. Really appreciate it.
Thank you, sir. Thank you.
Bye, everyone. Cheers.